Hi, everyone. With the importance of economic data of late, and we've certainly seen it from certainly the last two CPI prints that we've seen both sides of the pond, we have to make sure that we know how to trade this data. And whilst in this session, I'm not going to talk about entry levels, exit levels, stop losses, that usual stuff that we go through, that process. What I want to do is highlight a couple of events that we've had, and maybe give you a couple of tips on things that we should be looking outside of the the usual buy-sell side of our trading. So, trading over economic data. And what is it? What are we trying to do? Well, we're trying to take advantage of the volatility that comes around big data events. And, that in itself introduces a style where really we're trying to get in and out, a quick smash and grab trade, really. We're trying to realize a profit as the market digests the new news that comes in from this economic data, or it could be a rate meeting, or even some minutes, as we're going to see a bit later from the Fed. And what are the benefits? Well, one of the key ones is that it's a pretty binary event. If we're looking to trade medium term yen, we may see this as an entry point for a start of a trend or anything like that. But really what we're looking at here is scalping the market off the back of a release of a piece of new data. And so with that, with the in-out nature of it and the clear timing of when this comes out, we should be looking to place a fairly close, tight stop loss to our trade. And by definition, that means we can increase leverage on this trade, and that's good as long as we're disciplined around that. So it's three real messages I want to bring out here outside of that trading element. The first one is being selective. A lot of data comes out in a week, and we can look at our calendar first thing on the Monday morning, and maybe we see 10, 12 events. A key message from me is be selective about the ones that you choose to trade against. Really, to get best value for money, it's better to trade off the bigger, more meaningful economic releases. And by definition there, I'm talking about the bigger economies, certainly the G7. And really, they have to relate to the key market drivers at that point in time. And as we know at the moment, interest rates are key, the impact that they may have on inflation, or vice versa, the impact that inflation data may have on future rate hikes and the potential slowing down of those. So they're the ones at the moment that are key drivers, but these will change over the months, and we need to make sure we don't chase every release. At the moment, is there any point chasing a South African Q3 PMI number when it's old news, it's backward-looking data, etc.? So be selective about the actual release that you trade. And as well, within that, be selective about the product that you trade against it. Make sure it's going to be the one that gives you the best bang for your buck. The other thing I'm going to focus on is the fact that we do have to analyze and pre-plan before these events. So a lot of information to take on board. We need to understand what that release may mean, the interpretation of that number, how the market will take that on board, and where it can drive markets to. But there's a couple of other elements I really want us to take into account. The first one being sentiment. What is the market sentiment? And off the back of that, what potentially is the positioning of the market in our product set going into that number? Because that could help us identify how far a market could move, or even why it may not be doing exactly what we think it should be doing. So, trying to work out in our heads, how much maybe has been discounted, and does the market have the capacity to move further? The other side of it is, what is the overall context of this data release? What else is going on in the market at the time that could potentially take people's eyes away from this number and put more focus on something elsewhere? And hopefully I'll showcase both of these over the next couple of slides. So what must I know pre-data? Pretty obvious, really. We need to know the expected numbers. We need to know the previous numbers, because on some of these data releases, and the biggest one that comes to mind for me is generally the payrolls number, we can see some big revisions, and they can actually impact the move post-release. And the obvious thing we should always be doing is making sure we understand where are these key support and resistance levels, whether you use different chart systems, whether it's Fibonacci, anything like that. What are those important numbers? We need to have those at hand, because we can't be taking our time to look at a chart to see where this market can go to, because it could already have gone. Remember, we're talking about an event that could cause volatility. Well, what I'm going to show over the next couple of slides is what happened over the last US CPI number on the 10th of November. Again, key thing, what time, what date and what time are these releases coming out? We have to know that. That's the first thing. So always have that calendar up, know what it is. What we've got here is the expected number and the previous, so we can see what trend. And we should have these at hand. So why not stick it on a Post-it note? Put it on your screen, put it on your desk, make sure it's there and clearly available for you to interpret immediately. So off the back of that, what I'm going to go to is the US CPI release. Now, it's happened. We know it was a big beat to the downside from an inflation perspective. So month on month, year on year, it looked like the inflation number had come down pretty large, to be honest, and it was more than expected. So what we should firstly be doing, if we're not going to be trading rates, we should know the intrinsic link between yields and inflation and the impact that can have on other product sets. So if we'd have had that information on our screen, we would have immediately seen yields go from 4.15% in the US on the 10-year down to 3.82. Pretty sharp move, 33 basis points. That is the confirmation that we are interpreting things right. That should be the confidence to go into our product set and be as aggressive, jump in, because we should interpret from that. That's a big beat, and we could see a decent move from this. And as we see there, the tech shares rallied 9%, a bit further down on the right. S&P went up 6.5%. We will see other rallies in other stock markets around the world. But as I said before, let's be selective about what we're going to trade off the back of this. This is a US number. Yes, it will have a positive impact on global equities, but we should be trading US indices or individual stocks. Here, as we see, even the Russell 2000 went up 7%. And similarly, what we see here was a turnaround in the dollar. So the dollar clearly weakened off the back of lower yields. And again, be selective, choose your poison. You could have traded sterling versus the dollar, dollar yen, euro dollar, Aussie dollar. They would have all given you a decent return because it was the dollar element involved in that equation. Don't be trading euro sterling and expecting to make money out of it, because it's an irrelevance at that point of time. We're trying to scalp the market for dollar-based products, and that's exactly what I'm talking about when being selective. The key thing here as well, and this is something we should have gone into this realizing it was an important data release. Being selective, number one, we choose our product, we make sure it's dollar-based. The other key thing is understanding sentiment. And clearly the market wants to see a rally. It wants to feel positive about itself. So sentiment-wise, it wanted to make this market rally. So there would have been, a lot of interest in seeing this market go higher, certainly equities, and the turnaround in the dollar. But the other key thing I mentioned was market positioning. It was clear that we'd been in a long downtrend in stocks and the dollar had rallied for a long while. So we have to assume there was decent positioning in both those directions. And so with important news like this being such a big beat, we must anticipate that there could be a serious move coming off the back of this as those positions unwind, as well as people who have no position trying to get on the back of this move. And that should impact our trading as well. Yes, we want to scalp the market, but it should give us the confidence to be a bit more patient, to try and ride these rallies a little bit further and glean more money out of these releases. So as I move to the UK CPI, the important message here is context. And we could look at that number and it was completely the other way. You know, inflation went even higher. It was a beat on the upside. That should be negative, you know, according to the same rationale we put with the US CPI, it should be the opposite. So it should be positive for UK rates because it means the Bank of England will have to keep raising higher and maybe faster. It should be negative off the back of that for equities, and it may give some support to sterling. Well, if we go through that same process and we saw the UK 10-year yields, that market actually did not go up straight off the back of release. It went down. For me, that's a canary in the coal mine. It's showing me something is not right. The market's not responding. So I should be a bit concerned at that. And maybe it makes me a bit more cautious. Equities and currencies did not respond in the same way as I assumed either. So therefore, by being cautious, I may not have traded. I may have thought, what's going wrong here? Now, if I can add comment to the context side of things, what happened to stop these markets moving the way they should have done? For me, there was a couple of real big ones that weren't there in the US release and would have made me think differently about whether I should have even traded this UK CPI release. The big one from a local perspective was that the market was actually waiting for the autumn budget 2 days later. That seemed to be a more important one to see whether the government, what they were going to announce from it and whether they could actually bring credibility back to the government and make the numbers settle a bit better. So maybe the market did not want to respond too aggressively to this CPI release until it had all the information about the autumn budget. Another key thing, and this is where geopolitical side of it come in, the night before this CPI release, we had the issue with the missile going off in Poland. And so overnight and throughout that day, we still had no response from NATO, Ukraine, regards Russia. And that, again, would have put people off putting new risk into the market. So a couple of things there that maybe would have made us be more selective and not even trade this number because the context wasn't right and there was other bigger things going on in the market that may have detracted from what should have happened from this release. So 3 things there. Be selective about the data that you trade. Be selective about the products that you trade off the back of that. Certainly get a feel for the sentiment and the positioning prior to that release because it gives you a better feel for the extent of the potential move. And the other side is if there's a lot of uncertainty going on, again, that could help you be selective because the context may be not right for you to dive in and trade off that number.